So what are we looking at for this system? Well, the setup that I've got here, I've got a number of moving averages. Alright, so I've got the 20, I've got the 60, and I've got the 100 moving average. Okay guys, so note that down. And they're exponential moving averages. Alright, so we're talking about the 20, the 60, and the 100 exponential moving averages. These are kind of like my moving averages of choice. Now, how do we use the moving averages? Well, they're used in two ways. First of all, they're used to highlight to us when a trend is in place and when we can look to get involved in the markets. So when the moving averages are all kind of crisscross like this, they don't quite know where they're going, they look untidy, we don't want to be in the market. We don't want to be trading that, right? It's as simple as that. When the moving averages are aligned, so for a sell opportunity, the 20 is below the 60, the 60 is below the 100, we're allowed to look for sell opportunities in the market. Okay, so when they're aligned like that, we're allowed to look for sell opportunities. When they're aligned 20 above the 60, 60 above the 100, we're allowed to look for buying opportunities in the market. Makes sense so far? Okay, the other way that we use them as our strike zones. Okay, now what I mean by strike zone is ultimately you'll see that this opportunity here, it would have made you money. However, this is not an opportunity that we would have taken because the price had not pulled back into the moving averages. Okay, so between the moving averages, once the price touches the moving average, we'll call that sort of like our strike zone. So that's where we're looking to enter the markets. If the price doesn't get back to that area and it doesn't start to play with the moving averages, we're not really interested. Now, yes, that will mean you leave some on the table. So this one here, you would have left that. You wouldn't have made any money there. Nothing you can do about that. And it will mean that you do get into some opportunities which lose you money. But that's trading. Okay, there's absolutely nothing we can do about that. But what it does in the long run, okay, if you're looking for longevity in your trading, it will keep you out of more negative trades than it will keep you out of positive trades. Okay? What that allows you to do is, yes, we're looking to get involved in the volatility, but we're not just trying to jump in willy-nilly here and there. We're looking to jump in once we feel like we have an edge. Right? Moving averages are the average price of the last X amount of bars. All right? So if we're to say that the price is in a downtrend, we're looking to sell. And we wait for, so let's take this opportunity here. We wait for price to get back to the last 100. Okay, so we're between the 20 and the 100. This one here is touching the 100. What that's actually telling us, if we believe that we're in a downtrend, the market is going to sell off, we're saying that the price is now at the average price for the last 100 bars, for the last 100 candles. So what that actually means is that if the price is going to continue, this is probably a good place for the market to start to go short. Now, I'm not saying that the market goes short because it's hit the moving average. That's absolutely ridiculous. I'm not saying that at all. All I'm saying is this indicates to us that price has had enough of a pullback now. It's gone through enough of a price acceptance phase for us to look at getting back into the markets in the direction of the trend. So, we've got our chart set up, we've got the moving averages, we understand how we make them. So how do we enter? What is it that we're looking for? Well, first of all, we're looking for momentum in the market. So we're looking for the moving averages to be pulled apart, and we're looking for price to be pulling up back nicely. We like nice price action. Okay, so if you get price action like this here, I don't really know what to do with that. Yes, there's an entry, but would I have taken it? Very, very doubtful. Because it's kind of everywhere. I prefer pullbacks like this, a very nice smooth pullback. The reason I like a nice pullback like that is that when the opposite side, so the dominant force, get back involved in the markets, it's a lot easier to see. Okay, so you can see that the sellers, that this is all being sold off, sold off, sold off, and then suddenly, in fact, let me zoom in a bit so you can see the bars easier. Okay, then suddenly the bulls get involved. Okay, and that's something to take notice of, because what we're saying there is that, okay, if the bulls are involved here, if the dominant force are the buyers, what this must be is profit taking. So as soon as profit taking dissipates, then the bulls start to get back involved and they start to buy back the market. If they could push the market up here, like they did, and they're getting back involved here, one would imagine they can at least push it back up to the highs there, if not beyond. Okay, and that's the premise of our trading. That's what we're going on. Alright, so like here, when the market sells off and it pulls back to the moving averages, it's very clear when the sellers get involved, because all of this has pretty much been buyers all the way there. Then the sellers get involved, you got two nice big bars to the downside. No looking back. You want to be in there, look at what happens. You get a nice pullback here, look at that pullback, very, very nice. The sellers get involved, and you want to be involved in that there. You want to be getting short there. Okay, unfortunately this one doesn't come back to our strike zone, so we can't get involved. This one does, we get stopped out. Then we can get involved in this one here. That makes you money, although to be honest I didn't get involved in that one there. It looks like there was too much going against it. But anyway, this one here, again, nice short, nice short, nice shorting opportunity, and you can see they're just all over the charts there. Okay, so it's really, really very easy to see. Like, nice momentum, shorting opportunity, shorting opportunity, shorting opportunity. But the key here is the pullback to any MA. Yes, just pull back within that zone, Gil. The key here is to look at the price action. You don't want to be getting involved when the markets are kind of just, they don't have a clue what they're doing. You don't want to be getting involved in that. That doesn't make any sense for anyone. That's going to cost you money in the long run. You want to be getting involved when you can see where the markets are going, when you can feel the flow of the markets, if you like.